With this, let's move on and let's talk about the company which got listed today, and a good listing rather. And I'm talking about Sedemac Mechatronics. The management, Mr. Shashikanth Suryanarayanan, who is the managing director of the company, is joining us on the show. A very good morning, and firstly, congratulations on a good listing on the bourses. Now that you are a listed company, we can indeed talk financials. And I was just interested to know about your margins, because currently, if I see your EBITDA margins are in the range of 20%. The margins have expanded over the past 3 years. If you can help us understand what are the key drivers behind the expansion and how sustainable this growth is in the times ahead.
Yeah, so a few drivers. If you look at our numbers a little more carefully in our RFS that has been shared in the RHP, one you will see is that the gross profit itself is increasing. Okay, so essentially the percentage of raw material cost in our revenue has decreased. Now, what is the reason for this? There are multiple reasons. One is that our products which have higher profitability, essentially are control intensive ECUs, they have grown substantially. Second is that we have more leverage with suppliers in terms of semiconductor components, because they see us as a fast growing company. And third, even the semiconductor components that we are using, they have undergone a change, and we are using newer generation components, in some cases a bit cheaper. So all of this has led to our gross profit substantially increasing, and that is the prime driver of EBITDA percentage increases. Aside from that, there is the usual operating leverage argument that, you know, if your scale goes up, your percentage of fixed cost comes down, and that also contributes to EBITDA percent increases. So if you look at our numbers carefully, you will see these trends.
Right, and the company also has export revenue exposure towards US and Europe. In light of the trade deals that India has signed with these countries, what kind of incremental benefits are you factoring in already that could perhaps aid financials going forward?
This company has not been affected much by any of the tariffs or the trade deals that have been announced. The customers that buy from us are not buying on account of tariffs or export incentive situations. They are buying from us because we provide special products which not too many people in the world can provide, and therefore they are largely immune to these situations of special trade deals or tariff situations. That said, if a India EU large market is created, then it becomes easier to some extent for you to trade with the EU. So over a period of time, maybe the comfort and the fluidity of interactions could increase, but immediately there is no impact.
All right, good to know that. But is the company facing any headwind due to the ongoing conflicts in the Middle East? Any supply-related challenges that you are currently facing right now?
As of now, no. If you look at the markets we primarily serve, they are in the mobility and industrial spaces. One is 2- and 3-wheeler, and the other is generators. These markets, the 2- and 3-wheeler market that we sell to our customers, are heavily Indian. So unless something impacts the sort of 2-wheeler volumes or in a very dramatic way, we do not think that it will have an impact on the company significantly. The other is the generator space. That space is more like a power insurance business, so it never goes away. Even in the bad times, there is a demand always for power backup. So we don't see some direct impact of that in our business. But overall, if there is a trend to oil prices increases and that impacts some sort of sentiment somewhere, we will see some impact of that. But we are in the phase of introducing fresh technology which is growing much faster than what the industry is growing at. So we do not expect this situation to have an immediate impact.
Okay, so this is not likely to have any impact on the company. That's the word coming in. But the company has also parked about 17 crore worth of investments in certain financial assets for planned CapEx in the near term. Can you throw some light on the CapEx execution timeline and the anticipated capacity utilization levels going forward?
Yeah, currently our mother plant is completely utilized. If you look at our RHP, it's 90% plus utilization for the December 2025 quarter or 9-month ended. So it's very natural, and it's been the story of our company that we have constantly expanded our facilities because we have been a fast-growing company. So this is not a new situation. Of course, it is new for people coming into the IPO to see CapEx expansion, etc. So, but for us, it's a very normal, ongoing situation. We are expanding within Chakan into a much larger facility. In fact, 2.5 times the size of our mother plant in anticipation of the demand that we are going to get over the next years as we continue to expand our business. And for the first time, that will be in a leased facility. And for the first time, we are also purchasing some land in Hosur, which we have disclosed in the RHP. We are going through the process of diligence. It's SIPCOT land, and we have made a payment, and part of the payment was from internal accruals that were parked in these investments that you're talking about.
Lastly, Mr. Narayanan, if we talk about your key clients, then TVS Motors alone account for approximately 75% of your revenue. The number last time I checked, this was for 9 months ending December. What concrete steps are being taken to diversify the client base and reduce the dependency on a few anchor customers?
Yeah, the main thing is first to understand what we are doing in the marketplace. We are a company that has introduced fresh technologies. Okay, the word technologies is abused all over the place. But what we mean by that is a new technology is a new way of doing something. So, for example, until 2018, no vehicle in India that had an electric start did not have a starter motor. All of them had starter motors. So we have made a big change in that by introducing ISG, which completely eliminates the starter motor system. Okay, so we are the pioneer of ISG in India. And if you are making a big change, you typically will have 1 or 2 adopters who become your anchor adopters, who believe in it and see potential for them gaining ground on because of that. And that has been TVS Motors so far for us. And now Bajaj Auto is coming, and there is also Hero MotoCorp vehicle with our ISG. So when you are making a big change, it's very natural, and you have a limited set of adopters, and that's what happens to B2B technology companies. You have a limited set of adopters. You will naturally have customer concentration situations. So 10 years ago, when we were not in two-wheeler, we had a customer concentration situation with Mahindra and Kirloskar for generators. So we are not bothered much about this. We are more interested in seeing more and more vehicles adopt our technologies, and therefore naturally, because of adoption by various manufacturers, the customer concentration will come down. I don't know if you have looked at our numbers from FY25 to 9-month FY26, you will already see a 5% reduction. That's not through some conscious attempt to reduce the pie for TVS Motor. In fact, our TVS Motor share of revenue has grown even more, in the sense that revenue has grown even more, share of revenue has come down. So it's just the natural process that as more and more newer adopters adopt in newer vehicles, and customer shares will get distributed differently, and naturally TVS customer concentration will come down.
Right, so that's as far as diversification of your client base is concerned. Mr. Narayanan, thank you so much for taking your time out and joining us here on ET Now, and congratulations once again on your listing. But that's all the time we have in this edition of the show. Don't go anywhere. Buy now, sell now will come up next.